You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it is time once again for Options Playbook Radio, the program here on the old network where we break down the sometimes scary world of options into offensive and defensive plays that you too can utilize in your own portfolios. My name is Mark Longo from TheOptionsInsider.com, as well as, of course, from the aforementioned network. Pleased to be subbing in here again on the old OPR, a.k.a. the Options Playbook Radio program. But if you're saying to yourself, wait a minute, he's not the usual guy on this show, you are correct, keen-eared listener. So let me introduce now your regularly scheduled co-host, Mr. Brian Overby, the senior options analyst, a.k.a. the options guy over there at Ally Invest. Brian, welcome back to your own show, sir.
Well, thank you. Thank you so much for that wonderful introduction. And I always love when you and I can get together because that means we get to address these hundreds of listener questions, and that means that we're going to huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, let's get to it. The mailbag overfloweth despite Brian and my best efforts to pale it out. It continues to fill up, which, hey, good questions, good problems. Keep them coming. We love to hear from you guys. Let's see how many we can get in today. First off, Marival. Marival wants to know, what are your thoughts about selling strangles at the one standard deviation levels of a particular stock? I know, Brian, our audience, I think we had a question recently about one standard deviation as well. People have one standard deviation on the brain these days. All right, let's see. He goes on to write, sort of like a Bollinger Band strangle. Thoughts on this technique? Is it me, or are there new techniques for selling strangles all the time that always tend to blow out? Aren't you better off selling an iron condor or perhaps an iron butterfly due to limited risk? Well, yeah, first off, naked strangle selling, I don't think we've ever come out here and really advocated that offhand. We definitely prefer the more risk-mitigated approach, the iron condor. I'm an iron butterfly myself, but hey, to each your own. Maybe like a traditional fly, like Brian, maybe a bit of a skip strike fly. All of those have the wings to protect you against the extreme adverse scenario, so your risk is mitigated at the outset. We like those better than just naked selling a one or any strangle pretty much. So yeah, definitely I think they always tend to blow out. I don't know if always, but eventually it will catch up with you. We always say that's a strategy that works until it doesn't, right? And on the days when it doesn't, that's when you have to have a plan, because those days can leave a mark. And all the days you win a little bit, you lose a ton. It's not exactly a long-term viable strategy. But Brian, this is kind of reminiscent of a question we had not too long ago. I think they were asking then how you structure your skip strike flies using the at the money straddle rather than the one standard deviation. Here's a guy asking us what we think about using that one standard deviation as effectively the wings or the legs, really, of effectively a naked strangle. What do you think about that one, Brian? What could go wrong with that?
Right. What could go right is a little bit better question, I think. If you're looking at the one standard deviation strangle, that just means that you're taking the basic math, the bell-shaped curve, which isn't exactly correct in the options trading world, but they, in theory, use a bell-shaped curve to help set option prices. And that means that most of the time, and by most they define that as 68% of the time, the underlying stock, no matter what the management is, no matter what the news is, no matter what industry they are, based off of the implied volatility, the underlying stock usually stays within that range 68% of the time. So we're selling a put and we're selling a call. We're hoping the stock stays within those strikes if we do this type of trade. And the biggest thing about that is that the market doesn't always work the way that the theory does. So one of the biggest things is if you look at the big days, the big Black Monday or Black Fridays, and all these big moves that have happened in the marketplace, those days there's been 5, 6, 7, 8 standard deviation moves, which in theory should never happen, but in the real world they actually do. So I never suggest anybody in the retail space ever go out and just do these trades time and time again. And I think your phrase was perfect there, Mark, when you say they work until they don't. You're always, because by buying buying the wings is what a lot of people will say, because we're talking about iron condors and iron butterflies, for the cost versus the risk that you remove. The value is there to buy the insurance and to buy those wings. So if you're thinking about doing it, my suggestion would be that you want to lay down until the urge goes away. If anything, I think I'd rather do it the opposite way, where I wasn't selling it, I would just buy them. But then you got to have a lot of capital where you just keep buying them over and over again, and you wait for that huge one standard deviation move to happen. And then you got to have the cojones to stay in long enough. When would you get out if the market is tanking to the downside or taking off to the upside, and you are long that strangle? When would you end up selling it and trying to make the profit? So when it comes to this type of trading where you have these extremes, where you have unlimited risk, you have unlimited upside, they're interesting in theory, but man, it's really hard to do it in practice, where you say, okay, if it gets to this strike, or if I'm starting to lose on this trade, I'm just going to close it and get out. But then all of a sudden you wake up one morning and guess what? You didn't get the chance to close and get out because the market gapped open. So yeah, always the value of the insurance, the value you get from buying the wings on these type of strategies is well worth the risk mitigation.
I like that. If you're thinking about doing this, just lay down until the urge goes away. That's
right.
That's good advice, sir. I think we all could follow that advice to some degree in our lives. All right, let's keep on. Maybe our next listener should heed that advice. This is Scott Somer. That name sounds familiar. I think he's written in before. He says, if a calendar is too expensive in Amazon, is the following strategy that he concocted here, is that a legitimate way to reduce the cost? And he sends in his example. It looks like he wanted to buy the Ocnove, so a 1 month, $17.95 strike calendar in Amazon. Apparently that was too expensive. And that's understandable. Amazon, big high-priced name. The options are pretty pricey. So he thought he could reduce his outlay by turning around, effectively doing two verticals, by buying that 17. Remember, calendar listeners, if you're buying it, usually you're buying the longer-term contract, selling the nearer terms. In this case, he'd be buying the Nove 1795 call and then selling the Ox 1795 call. That's a standard calendar. He wants to add a couple of legs to it. He wants to sell the Nove 1855 call, so effectively buying that Nove $60, sounds like this is around at the money when he did this, so an at the money vertical there, and then turning around and also selling the $60 vertical in October. So selling the 1795 call, buying the 1855 call in October. So effectively doing two 60 handle verticals, one in Nove, one in October versus the straight up calendar. I have to say I don't see a lot of utility to this approach here. You know, you're selling that one 1855 call, so that's getting you something, but you're buying the OC one. Granted, the Nove's going to be worth more, so you're getting a little bit more there in premium, but maybe not enough to offset doing all the rest of this and all this. This is almost effectively like a bit of an at the money box, which is not a thing that is done. Boxes obviously are usually done in the money. They're a carry play. So this is a bit of a funky one. He adds here, Scott, is there an additional risk to this I'm not seeing? Outside of risk, I don't know, Brian. I just don't see the value, the utility of going to all this effort for whatever small nominal amount of premium reduction you're going to get. Does this approach resonate with you, Brian? The I guess effectively, for lack of a better term, the at the money vertical calendar as opposed to straight up calendar?
So yeah, if I look at this, you're right. I think what has been concocted is either a box or a jelly roll, and I don't remember exactly which one it would be, and I would have to look at it inside an actual profit and loss calculator to come up exactly what's going on here. But ultimately, it looks like you're doing a trade where you're just basically going to end up with the maximum you could make is the risk-free interest rate. And when traders did this down on the trading floor, that's all it was an interest rate play. Now, if you could lean and you could get some decent prices because you were a trader down on the floor and you could buy, on the bid and sell on the ask, well, then it may be feasible to try to attempt this trade. But definitely, if you're going to put this all on as one trade and you're going to try to execute this at a benefit to yourself, it's really not going to work out. And it's just, there's a lot of commissions involved, a lot of headaches. And like I said, I'd want to throw it into a profit and loss calculator to get, but I'm just going to say steer clear. I don't really see the benefit of all this, but I see you had the same strike. I see that he has the same strikes in this trade on with different expirations. I would just steer clear. If Amazon is just too expensive overall, just find a different underlying. There's other ones out there, and if you're doing these type of trades, there are just different opportunities in other underlyings that can have kind of the same volatility. You just want to look at same volatility, try to look at a little bit more expensive stock, but not quite a $1,700 stock, and maybe look at the calendars in those underlyings. I don't like this trade, just flat out, by looking at what's going on here.
I think the theme for our episode is if you have these desires, just lay down until they go away. We're 2 for 2. We're 2 for 2 on the lay down. That's going to be our advice going forward. Just lay down until the urge passes. Let's see if we're 3 for 3 here. Next up, we have Jay. Jay wants to know. Jay says, hi. Well, hi, Jay. I love swing trading, but struggling. I have a small account and I trade and I think it means and I trade options. Gotta love the truncated usage of characters on social media. So I have a small account and I trade options. Do you recommend 30 delta versus at the money or just trade in the money? Also, 2-week options versus 30 or 60 days. Thanks. Well, there's a lot packed into this very short amount of characters in terms of questions. Jay, let's see. I mean, thematically, this is the type of question we receive a lot, which is kind of what is the appropriate use case, or is there an appropriate use case for options when you're doing much more day-to-day, minute-by-minute kind of swing trading and scalping like a futures or a stock guy. The Delta One kind of guys usually do. They always have a hard time wrapping their heads around the proper use case for that with options. First off, you say you have a small account, so that's going to give you a little bit of a challenge there. Remember, a lot of the typical use cases for options are longer than one day. You could certainly do intraday. It's doable. It has been done. It is done every day. But a lot of the use cases that come through to it are hedging a little bit longer term, maybe generating income a little bit longer term. Remember, there's things like time decay, and that takes time by definition for it to make its impact known. So if you're relying on time decay as part of your strategy, that's going to require a little bit of time. for that to work out. So not all of these types of strategies you talk about here are utilized very easily in a minute-by-minute kind of scalping type scenario, like I assume you're talking about here. So there's a couple of complications. You're trading in the money. Obviously, you're going to get a little more expensive as more premium allowed. So that might be prohibitive from a small account. But of course, more delta, that's what you're going for here, delta. The more delta you're getting, the better for someone who's looking to scalp tick by tick like you are. So Brian, there's a lot here in this question, even though it's very short. And also there's a lot of challenges here because this is the guy who wants to get in there and start slinging and maybe scalp and trade minute ticks of the underlying, but he doesn't really have the bankroll to do it. So what do you recommend? I'm sure you get questions like this a lot. What do you recommend? Maybe you recommend he sticks to a cheap underlying and forget the options altogether. What? Maybe he becomes a future scalper. What do you think our friend Jay here should do?
All right. So you're right. There's a lot to unpack in this, and I think the Greek that I would talk about is gamma. Now, I'm assuming that Jay is buying options just from the way that he worded the questions here. And the biggest thing is to understand gamma. If I'm looking at the money option contracts and I'm correct on my forecast, I want gamma to work for me. I want gamma to increase or accelerate my delta. And the way that I always approach this when I'm teaching the Greeks to a bunch of newbies or even more advanced people, a lot of people just don't understand the concept of gamma. I don't think you ever really need to look at the gamma, quote unquote, and get that number for that option contract, but you need to understand what it does as expiration approaches. So if I have an at-the-money option contract and you think of delta, and that at-the-money option contract should have a delta fairly close to 50. I don't care if it's a call or if it's a put. If it's at-the-money, it should be around 50. But if the market goes in the money and there's 1 day remaining, guess what? That delta's got to go to 1. If there's 60 days remaining, that delta's going to go to 55 or 45, depending if it goes up or down. So in other words, it's going to move a lot slower. So to answer your question overall, first of all, we need to know the underlying you're talking about. There's just, this could be a seminar in itself, but understand the concept that if you go out further in time and you are buying option contracts, that's great. It gives you a slower rate of decay, but it also gives you a slower moving option contract. So when you're correct on your forecast, it takes you longer in order for your option to double, if you will, by looking at the price of the option contract. Whereas on the shorter term options, well, now you have this huge rate of time decay, but guess what? That delta is explosive and it's really going to move. So what would we recommend? Unless I know the forecast and what you're looking at, and that's what we do on Options Playbook Radio. As a matter of fact, this actually is a great premise for Options Playbook Radio because that's what we're looking for. We're looking for scenarios where this one strategy that's mentioned in the Options Playbook might fit the underlying for that week. And we talk about why it does. And a lot has to do with how the pricing is on option contracts and how we'd like to do butterflies after earnings. Why? Because if I do a short-term butterfly after earnings and I'm correct on my forecast, I get a huge rate of time decay, and I also get a lot of volatility crunch coming in, which can help if I'm correct on my forecast. So when you think about swing trading, you got to think about how much time decay there is relative to the gamma, to the explosiveness of your option contract. And actually, now they use different Greek symbols for it, but there are a lot of option pricing calculators that will actually give you a ratio of gamma versus theta. And they'll call it epsilon or they'll call it some other Greek letter, but just because you're trying to manage that ratio, and that's one of the hardest things for swing traders to know, should I buy a 30 delta option contract? Well, yeah, you should if you think the stock's going to get there, right? But if you're buying 30 delta, you need that option contract to get in the money. If you don't think it can get at least 50 cents to $1 in the money when you're doing that type of trading, then you don't want to buy a 30 delta option contract because time decay is going to kill you. So yeah, that's a loaded question there. I tried my best though. You gotta appreciate the effort, huh, Mark?
Yeah, there's a lot squeezed into that 250 characters or whatever that is there. Yeah, Jay, if you want to follow up with more specifics about what underlying you're looking at, that would certainly help us. It is challenging given the limited amount of data you gave us to really provide you with specifics, particularly because a lot of the techniques people use in that type of space that want to do what you're doing usually are a little bit more capital intensive, whether it's synthetics or deep in the monies or things like that. Those usually require a little bit more of a bankroll, and it sounds like that's an issue for you. So yeah, write in, give us some more specifics, and we'd be happy to maybe come up with some more tailored ideas. But it is challenging, and as Gamma, I called you Gamma, Brian. That's, I like that. As Gamma, as Brian alluded to there, the Gamma, getting your bang for your buck is your key focus there. We want to focus on this. So give us some more ideas of what it is you're doing, and maybe we could help give you a little bit more specific guidance. But that's an interesting, maybe that's a good topic for a future playbook, OPR episode, Brian. Using options for smaller time horizons and maybe with smaller accounts, you know?
Mm-hmm. When and which option to buy.
Yeah. So, man, maybe Jay doesn't have to lay down. His question wasn't bad. He's good. I'll tell you what, we're generous. We'll squeeze one more on here onto the show. This one comes from Alto. He's got a bit of a out of left field one. He wants to know, which do you think has a better chance of happening? No more earnings calls or after hours options trading? And which do you think would be more impactful for options traders? And do you have a preference? Well, my preference, I think, would clearly be the after hours options trading here, Alto. I've been beating that drum for a long time. I have chatted about it with Brian. Whenever I do my hits down at the OIC conference every year, I make sure that's a topic I bring up to all of the various exchange leaders and heads of the brokerage firms to put it out there, because we get that request all the time. People want to have access to that liquidity. Maybe not fully understanding of all the consequences therein for doing that, but that is a request we get a lot, so I put it out there. I hear mixed things. I did just very recently, actually, get reached out to by someone who used to be on one of our shows regularly out of the blue and said he heard some behind-the-scenes conversations that maybe all of a sudden after-hours options trading is getting a little bit more traction out of the blue. So I would have to say, based on the recent scuttlebutt that I heard, the after-hours options thing, the no more earnings calls thing, I know what you're referring to. That seemed like that was all the rage about a year ago or so. As I recall, Warren Buffett was behind it, a few other big investors. They said it added to too much market volatility, so they wanted to maybe spread out the calls a little bit. I think even Trump weighed in on it. So it seemed like they have a little bit of muscle, but it seems like Trump and others have moved on to other things like the trade war of late. We haven't heard much on that front. So I don't think either of these is going to happen anytime soon. But if I had to weigh in on one, I would probably weigh in on the after-hours options trading. I think that would probably be more impactful for options traders as well, because it gives you more access to liquidity. Brian, first off, which of these do you prefer? Would you prefer the after-hours trading or earnings calls going away? And which do you think would be more impactful? And also, which do you think has a better chance of happening? 3 questions here from Mr. or Mrs. Alto.
Well, they've tried after-hours option trading, and they do kind of have it in the S&P 500 index, in that you can still trade for 15 minutes after the close. But the biggest thing about the after-hours, it's only a 15-minute session, but about the after-hours option trading is that the markets are going to just be extremely wide, because if the people making the markets in the options don't know exactly what they can buy on the ask and sell on the bid, as far as their hedge is concerned with the underlying, their bid-ask spreads are going to be extremely wide. And they've tried it. They've done a couple of test cases. I mean, a long time ago, I recall at the Chicago Board Option Exchange, the concept just keeps coming back time and time again. In this day and age, with the advent of all the electronics on the marketplace, you know, maybe they can pull it off. But back then, it just did not work. The markets were just too wide, and they just couldn't do it. Now, no more earnings calls. I just think, if I look at that and I think about it, it just gives the concept of them not being forced to tell you what those earnings were for a quarter, I think would be just kind of scary overall. I think there's a lot of transparency in the earnings call, and I would not like to see that by any means. I guess I would have to be in a world where that happens. I mean, will they be announcing more often than less often? Instead of doing it once a quarter, they're doing releasing data once a month. But I think after-hours option trading would be wonderful It's just all about the liquidity of the underlying in the after hours. We see many times where companies announce earnings and the stock will go down 10% only to open up the next day 5%. And it's just kind of odd, and a lot of that has to do with just the fact that there's just not a ton of people that are to add liquidity to that after-hours market in the underlying stock, let alone the options.
Well said, sir. We'll have to leave it there. Keep those questions coming. So if you too want to join Marival or Scott or Jay or Alto on the program, maybe you have a question you want to feature on OPR, maybe you want to hit up Brian directly. You can't wait for our next Huddle episode, even though they are coming pretty fast and furious of late. But if that's too far apart for you, you want to get your question asked directly to the options guy himself. Brian, where should they go? What should they do?
Yeah, and my inbox has been filling up recently, I have to admit. So I guess people have been listening to this email address. It is theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. And I want to say thanks to you, Mark, for hosting, and thanks to you for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.